You find a high probability setup and enter the trade. And then, almost immediately, the price turns against you and tags your stop loss. But the real sting comes next. The very second you're out of the market, the price whips right back and surges in your original direction. You had the right idea, but you were left behind. You have to wonder, is that just terrible timing? A string of random bad luck? Or is there a specific, repeatable reason why the market returns to those exact levels? These reversals follow a structural sequence. By mapping specific price points, we can see where large institutions settle their previous positions before the market continues its trend. Operations on trading floors like the CME Group involve volumes that physically shift the market price. Large commercial banks and hedge funds operate under a different set of constraints than retail traders.
Because of their immense size, they often accumulate losing trades while manipulating price to build a larger position. They have a requirement to return to those levels to settle their books. They have unfinished business. This requirement is trackable through a technical pattern known as an ICT Mitigation Block. It allows us to identify the exact price range where these institutions are forced to rebalance. Learning to read these blocks allows you to stop guessing at random price fluctuations. Instead, you can anticipate the points where institutional order flow will likely shift. Let's walk through the sequence of a trade, using a large bank trying to heavily short the euro-dollar pair as an example. The bank drives price upward, creating a swing high resembling a breakout, trapping retail buyers. Then, the institution aggressively reverses, crashing past previous support. This market structure break triggers retail stop losses, providing massive liquidity for the bank's short positions. By triggering those retail stop losses, the institution generates the specific volume it needs to execute its true directional bias. But forcing that initial upward move was expensive. The bank had to buy at the top to create the rally. Now that the price has crashed, they are holding losing long positions. Looking closely, those stuck trades sit in the final green candle, from highest wick to lowest, just before the downward break. This is the mitigation block. The bank guides the price back to this window to close losing longs at break-even before continuing lower. A mitigation block is an area where institutional positions are underwater. When price returns to it, we are seeing a forced rebalancing maneuver. Precision is critical here. To trade this effectively, you must distinguish between a mitigation block and a breaker block.
This split-screen chart shows the difference. On the left, the mitigation block forms because the initial upward swing failed to break the previous high. On the right, the breaker block actually successfully sweeps past the old high to grab liquidity before the crash. Mitigation occurs after a failed attempt to go higher. A breaker occurs after a successful raid on prior highs followed by a sharp reversal. Identifying which scenario occurred tells you which block you're trading. When you spot a mitigation block, avoid chasing the falling price. Wait for the market to retrace back into your marked zone. To refine your entry, find the block's 50% mark, or equilibrium level. Entering here provides a much higher reward-to-risk ratio. Place your stop loss just outside the top edge of the candle box. If price breaks above that line, the institutional defense is over. Instead of aiming for a random number of pips, set your profit target at the next major structural low. The market is naturally drawn towards these liquidity pools. This framework shifts the focus from chasing price to waiting for the specific points where institutions are forced to rebalance their books. Mitigation blocks are more reliable when they align with other signals. Look for blocks that form inside higher time frame imbalances or at Fibonacci retracement levels. Volume is also key. Look for these setups during high liquidity periods of major session kill zones, like the London or New York Opens. Trading these specific levels requires an environment built for institutional speed and fast execution. You can align your trades with these institutional requirements by opening an FXNX NX1 account. With 0.0 pip spreads and NX AI charting tools, you can map and execute your next mitigation block with precision.